I was grabbing coffee with a senior treasury manager at a multinational firm a few weeks back. He was practically beaming, sliding his laptop across the table to show me their latest risk assessment. "Look at these numbers," he said, his voice full of that quiet confidence of someone who thinks they've solved the puzzle. He pointed to a subsidiary's balance sheet, flawless liquidity, low leverage, and a cash pile that could weather any storm. To him, those figures represented the ultimate safety. He kept calling the company untouchable. But then a notification popped up on his smartwatch. Just a brief headline about a mid-sized clearing bank in a different time zone being cut off from the global messaging network due to a new regulatory intervention. The change in him was instantaneous. The smugness evaporated. He didn't even finish his coffee. He was already on his phone, hands slightly shaking, trying to reach his counterpart in Singapore. That $40 million he'd just been bragging about. It hadn't disappeared, but it was effectively gone. The borrower was healthy, the cash was there, and the contract was signed, but the pipe had been cut. It was a jarring sight. A man who had spent 20 years mastering balance sheets, suddenly realizing he was powerless because of a layer of the world he'd always assumed was neutral. We've spent decades treating the infrastructure of global finance like the air we breathe, essential but invisible. We analyze the swimmer's strength and their lung capacity, but we never think to check if someone is draining the pool. That hidden layer is no longer just a background detail, it's becoming the most volatile variable in the room. What happens to credit risk when the borrower is perfectly fine, but the road to the bank is suddenly erased from the map?
Yeah. I mean, that is the exact paradigm shift we're unpacking in this deep dive today.
Right.
Because that hidden plumbing, the clearinghouses, the correspondent networks.
The stuff nobody wants to think about.
Exactly. It's completely ceased to be this passive utility. It's now a targeted mechanism of exclusion.
Which totally breaks traditional corporate credit risk analysis.
Completely breaks it. Historically, we obsessed over debt-to-equity ratios or cash flow projections.
Sure, it's standard metric.
Right. But those metrics are meaningless when geopolitical interventions just physically sever the pathways that allow the money to move.
So to really grasp the physical reality of that breakdown, we need to go to Moscow, specifically early 2022.
Yeah.
Right. Because when we think of a billion-dollar energy firm, we usually picture this untouchable corporate machinery.
Absolutely. Mathematical fortresses.
But the reality of infrastructure failure is incredibly visceral. There's the story of Elena,
The CFO.
right, the chief financial officer of one of these massive entities in Moscow. She had spent 2 decades perfecting liquidity management.
Doing everything right, by the book.
Exactly. And in February of that year, her company was mathematically bulletproof. They had record-high foreign currency reserves.
Unprecedented amounts of cash.
Right. Yet she finds herself sitting in an office that smells of stale coffee and that metallic ozone from overheated server racks, just staring at a blinking cursor on a frozen payment terminal.
Because the hidden layer had materialized into a literal wall.
Exactly. She described this nauseating shift from being this titan of industry who could move millions with a keystroke to just feeling like a ghost in the global machine.
Oh, a ghost. That's a powerful way to put it.
Yeah, and because of these sudden sweeping sanctions on the underlying infrastructure, her firm's massive assets were just numbers locked in a vault. The money was there, but her digital signature was worthless overnight.
It's wild to think about. She wasn't fighting a competitor.
No.
And it wasn't a market downturn.
Right, she was fighting digital exclusion. The vulnerability was in the fragile pipes of the clearing system, not her balance sheet.
And Elena's frozen terminal is actually the perfect entry point to understand the architecture of these correspondent banking relationships.
Why did her screen actually go dark?
Well, we have to look at the mechanics of cross-border capital. When a company, say, initiates a US dollar payment, their local bank doesn't physically load paper currency onto an airplane.
Right.
It's entirely reliant on a chain of ledger entries between allied institutions. So Elena's local Russian bank held what is called a Nostro account.
A Nostro account.
Yeah, Nostro translates to ours. They held this account with a correspondent bank physically located in the United States.
Okay, so the U.S. bank is the anchor.
Exactly. That U.S. bank has direct access to the Federal Reserve's clearing systems, like FedWire or CIPS. So when Elena hits send on her terminal, she's actually just asking her local bank to send a digital message to that U.S. correspondent bank.
Basically saying, hey, move this money.
Right. It says, please deduct $10 million from our Nostro account with you and credit it to this other entity.
because they don't send a tactical team to dismantle Elena's local bank.
No, sanctions legally compel the U.S. correspondent bank to sever that specific ledger connection. The U.S. bank just simply refuses to acknowledge or process the incoming messages. The bridge is blown up from the other side.
So it creates this complete institutional vacuum. And, looking at the data from that specific window of time, the velocity of the collapse is just staggering.
Oh, it was overnight.
Yeah. Before those interventions, these targeted banks were deeply woven into everything. A typical mid to large Russian bank might clear payments in over 7 different currencies.
Right.
They'd maintain correspondent relationships across half a dozen foreign countries. In fact, nearly half of those banks, 47.7% to be exact, had direct U.S. dollar correspondent relationships with banks on U.S. soil.
Almost half.
Almost half. But following the sanctions, that direct access plummeted down to 16.3%.
Just fell off a cliff.
In a matter of days. And it wasn't just the dollar. The exact same infrastructure collapse happened across euro and British pound clearing networks, too.
The primary arteries of global commerce were just systematically clamped shut.
Which brings us to the rating agencies, right? Because that sudden lack of oxygen forced a complete failure of traditional risk models.
Totally. The major rating agencies had no idea how to handle it. Throughout March of 2022, you saw this rapid, unprecedented cascade of downgrades hitting major Russian financial institutions.
Right, entities that were considered super stable just weeks prior.
Yeah. Alpha Bank, Gazprom Bank, Credit Bank of Moscow, suddenly slashed down to a CC rating.
And CC in agency speak basically means, what, highly vulnerable?
It effectively signals that a default is imminent. And shortly after that, the ratings were just completely withdrawn from the market.
I want to pause on that mechanism for a second, because if you think about the methodology of traditional credit ratings, it's essentially an exhaustive medical exam, right? The analysts are checking the heart, the lungs, the blood pressure of a company. They look at operating margins, stress test debt service coverage, historical default rates.
All the classic vitals.
Exactly. But an infrastructure sanction is like suddenly removing all the oxygen from the room. It absolutely does not matter how healthy the patient's lungs are if the environment itself is voided.
Exactly.
So S&P and the other agencies didn't downgrade these banks because their domestic loan portfolios suddenly went bad, did they?
It had nothing to do with traditional solvency failures. The downgrades were triggered by 2 very specific external interventions.
Okay, what were they?
First, the European Union imposed a strict April 15th deadline that legally banned the provision of credit ratings to Russian entities.
Just a flat-out ban.
A flat-out legal ban. And second, the Central Bank of Russia imposed its own severe currency restrictions to prevent capital flight.
Right, trapping the money inside.
Exactly. Which capped what the agencies call transfer and convertibility assessments. So the rating agencies had to officially acknowledge that default on foreign currency obligations had become a virtual certainty.
But not because they lacked capital?
Precisely. The default was born out of a total loss of the institutional pathways required to service the debt.
Ow.
If you owe a bondholder in London $10 million and you have $10 million sitting in your account, but the correspondent network legally blocks the transaction from routing through London, you default.
The pristine balance sheet basically becomes a work of fiction.
Complete fiction.
But, I need to push back on this idea of absolute airtight containment.
Sure.
Because if you're dealing with multinational firms moving hundreds of millions of dollars, doesn't that money eventually find a leak in the plumbing? Like, if the direct, highly regulated route through New York or Frankfurt is blocked, surely these massive entities just route around the damage. They find a back door, don't they?
Well, they definitely attempt to build backdoors. And you're right, the connectivity is rarely reduced to absolute zero. But it is severely degraded.
Okay.
When the direct route is severed, institutions are forced to shift to indirect, highly fragile chains of intermediaries.
How does that actually look in practice?
Let's trace it. If a sanctioned bank is cut off from clearing dollars directly through a prime correspondent in New York, it will try to find a mid-tier bank in a third country.
Like a jurisdiction that hasn't officially signed on to the sanctions.
Exactly. And the sanctioned bank asks that third country bank to clear the dollars on its behalf.
So instead of the payment traveling directly from point A to point B, it has to bounce from A to C to D and then hopefully land at B.
Yeah. And every single one of those additional nodes introduces profound friction into the system. It's no longer a seamless digital transfer.
Because everyone wants a cut.
Higher transaction costs. Exactly. Plus massive temporal delays. The transaction has to sit in a queue to be processed by the compliance software of every single bank along that new convoluted route.
That sounds like a nightmare for counterparty risk.
It's massive counterparty risk. A payment that used to clear in a matter of seconds can now take weeks. And it's entirely dependent on the weakest link in that new chain.
So the money might eventually flow, but the system is infinitely more complex and just prone to failure.
Really.
Which naturally brings us to the collateral damage of these fractured systems, because this fear ripples out far beyond just the sanctioned zones, right?
Absolutely. The contagion is global.
Right. And to really understand that, we have to look at the humid, paper-stacked back offices of Istanbul.
Yeah, the Demir case study.
Exactly. I want to talk about Demir. He's a trade financier, and his entire career was built on navigating the gray zones of correspondent banking. Specifically, connecting emerging market suppliers with European buyers.
A vital link in the chain.
Very vital. And his story illustrates the brutal reality of this phenomenon called de-risking. So several months ago, a major New York-based bank just severed its correspondent relationship with Demir's local partner bank.
Just cut them off.
Just cut them off. They didn't cite any specific violation. The termination notice just said geopolitical caution.
Geopolitical caution. Vague.
Infuriatingly vague. And for Demir, this wasn't just like a lost line of credit. It was the loss of his ability to prove his clients even existed to the outside world.
Right, because the pipes are gone.
Yeah. I mean, he's sitting at his desk, hands trembling slightly, flipping through this thick stack of paper invoices. And he explains that a massive shipment of vital industrial components, perfectly legal, totally compliant goods, is currently rotting at the docks.
Rotting at the docks? Why?
Because a mid-tier bank in Frankfurt refused to recognize a payment originating from his specific geography. The algorithms just flagged the entire region as too complex to bother with.
Wow. Just threw the baby out with the bathwater.
Exactly. And there was this very specific, quiet shame in Demir's voice. The shame of a professional who did everything exactly by the book, only to be discarded by a banking algorithm.
An algorithm designed to mitigate regulatory heat in a completely different hemisphere.
Right. To him, credit risk isn't about analyzing a borrower's character anymore. It's about the shadow cast by a distant correspondent bank's fear. It's a variable no traditional model could ever quantify.
And Demir's situation in Istanbul, that's just the micro-level devastation of a massive macro-level psychological shift in global banking.
Let's talk about that macro shift. Where does this algorithm of fear come from?
To truly understand it, we have to rewind the clock to 2014. That year was a fundamental trauma for the banking industry.
The BNP Paribas fine.
Exactly. U.S. regulators fined the French bank BNP Paribas $8.9 billion for processing transactions on behalf of sanctioned entities in Sudan, Cuba, and Iran.
$8.9 billion.
With a B.
With a B. The sheer size of that penalty was a brutal, unforgettable wake-up call to compliance departments worldwide. It completely altered boardroom psychology. Because suddenly the math of global banking changed. Like, how did banks view these relationships before that fine versus after?
Well, historically, providing correspondent banking services to a local bank in an emerging market, like Demir's partner in Istanbul, was viewed as a low-risk, low-margin utility business.
Right. You set up the pipe, take a tiny fraction of a cent on millions of transactions, and it's just a steady volume play.
Exactly. But post-2014, the regulatory scrutiny intensified so much that the calculus completely inverted. Those exact same relationships were instantly recategorized as high-risk, low-margin.
Because of the AML and CTF compliance costs.
Yes. Anti-money laundering and counter-terrorist financing. The board level realized that the potential penalty for a single compliance failure, just one illicit transaction slipping through the network, could completely wipe out 20 years of profit generated by that entire regional relationship.
So if you're an executive sitting in New York or London looking at a spreadsheet of global risk, the logical corporate response isn't to hire more compliance officers in Istanbul. The logical response is simply to sever the tie, to amputate the connection entirely to avoid the risk of regulatory infection.
And that amputation was swift and staggering at scale. This is the essence of de-risking. Between 2011 and 2018, we witnessed a massive 20% global decline in active correspondent banking relationships.
20% of global connections just erased.
Erased. Banks were systematically pulling up the bridges to emerging markets. And this retreat is even more dangerous when you realize how concentrated the system is.
Right, it's basically an oligopoly.
Just 5 major U.S. banks handle approximately 92% of all U.S. trade finance claims.
Wait, 5 banks handle 92%?
Yes. So when even one of those five giants decides to adjust its risk appetite and pull back from a specific region, the ripple effects leave entire geographic zones stranded.
Stranded from the lifeblood of global trade. You know, if you're running a mid-sized manufacturing business somewhere outside the major financial hubs, you might think this macro-level banking drama doesn't apply to you.
Does.
The research we are looking at shows this translates to mathematically verifiable economic devastation at the firm level.
Look at the data out of emerging Europe.
Right, places like Bosnia, Croatia, Hungary, Turkey. When a local bank in one of those countries loses its correspondent pipeline, the impact on local businesses is just brutal.
Immediate impact.
The probability of a local firm exporting drops by 3.8 percentage points almost immediately.
And the decay curve only accelerates from there.
Think about what this means for, like, a factory in Croatia. After 4 years of that banking relationship being severed, their probability of exporting plunges by 35.2 percentage points.
That's a catastrophic drop.
And within 2 years of the initial disconnection, the export turnover for those firms drops by over 53%.
More than half.
Over half. That is not just a bad quarter. That means half of their assembly line goes dark. Not because their product failed, but because a compliance officer in New York decided the paperwork for their region was too annoying to maintain.
And this data is so critical because it shatters a fundamental assumption in classical economics.
One.
The idea of firm adaptability. The theoretical assumption is usually, well, if a firm is blocked from international markets, they'll simply pivot and sell their goods domestically.
Sure, just find local buyers.
Right. But the granular analysis of these de-risked regions shows that domestic substitution is largely a failure. They attempt to pivot, but the local market simply cannot absorb that massive volume, nor can they match the premium pricing of international buyers. The loss of export revenue is practically irreplaceable.
So the business just shrinks.
The total turnover shrinks dramatically, and with a slight temporal delay, usually about 12 to 18 months, the workforce is inevitably reduced. People lose their livelihoods because of an algorithmic adjustment made a continent away.
Yeah. And what's perhaps most alarming in the data is this spillover effect.
Oh, the spillover effect is fascinating and terrifying.
Right. Because you might assume that only the companies banking directly with the severed institution are the ones getting hurt.
That's not what the research indicates.
No. The data shows that even perfectly healthy, fully compliant control firms, companies banking with entirely different, fully connected institutions, they suffer massive losses too if they operate in the same industry and geography.
It's guilt by geographical association.
Exactly. It creates this regional contagion of distrust. Trading partners in Germany or the US begin to view the entire sector in that emerging market as fundamentally unreliable.
Simply because the payment chains for a few competitors are broken. The infrastructure's failure completely overrides the individual firm's operational excellence.
Ow.
Because if a supplier can't guarantee that a payment will clear, the buyer isn't going to wait around. They will just find a supplier in a different country.
This is the core argument for why the architecture of the payment network itself must be factored into any serious corporate credit analysis today. And, you know, we see the ultimate culmination of this infrastructural weaponization when we look at the exclusion from the highest level of global messaging networks.
Right. The swift severance.
Yeah. We have this third perspective in the source materials from an entrepreneur who lived through the sudden severing of the swift tether, Miriam. She ran a highly successful high-tech medical import business, and she described the day her nation's banks were excluded from the SWIFT network. She called it a feeling of sudden, violent amputation.
Because she was completely cut off from the global grid.
Exactly. She had to navigate this primitive shift, transitioning from seamless, split-second digital transfers to the frantic, sweating reality of the Hawala system and physical ledger books.
It's a staggering regret.
The vulnerability she faced wasn't a liquidity crisis. It was an existential threat to her ability to operate in the modern world. She spent an entire night just staring at a rejected wire transfer for life-saving diagnostic equipment.
Ricky, and it highlights exactly what SWIFT actually is.
Right, because there's a crucial misconception about SWIFT, isn't there? People think SWIFT moves money.
And it does not. SWIFT is purely a messaging system. It's the nervous system, or really the air traffic control of global finance.
Air traffic control.
Yeah, it securely transmits highly standardized, cryptographically signed messages, like the famous MT-103 message format.
Okay, MT-103.
Right. And those messages instruct banks to update their ledgers and actually move the money. So when a nation's banks are exiled from SWIFT, The banks still physically exist, right?
Sure.
And the capital is still sitting in their vaults. But they're entirely isolated from the global air traffic control grid. They can't send or receive the trusted instructions required to settle cross-border trades.
Which explains Miriam's forced reversion to the hawala system.
Exactly. Hawala is an ancient, informal value transfer system. It relies entirely on a network of brokers who honor debts based on personal trust and physical ledgers.
Settling balances periodically outside of traditional banking channels?
Right. And while it's incredibly resilient at a local level, it is entirely unsuited for the volume, speed, and transparency required for complex, high-tech medical imports.
Vacuum. And so does global capital. If the primary network, the dollar-centric SWIFT system, is weaponized, alternative architectures emerge almost out of sheer necessity.
Absolutely. The reconfiguration of global payment networks is happening right now.
Right. We're seeing countries with massive exposure to sanctions, nations like Belarus, Kyrgyzstan, Myanmar, and Russia, rapidly reorienting their entire payment infrastructure.
The speed of that reorientation is remarkable, and the data paints a very clear picture of where they are turning.
Where are they going?
We are observing a massive systemic shift toward the Chinese yuan, or CNY, in these specific jurisdictions.
Okay, the yuan. How big of a shift?
Well, between 2021 and 2025 in these highly sanctioned nations, the share of yuan-denominated correspondent relationships jumped significantly. We are seeing increases of 2 to 10 percentage points.
2 to 10 percentage points in just a few years.
Yes. Financial institutions in these countries are aggressively expanding their direct connections to China's CIPS.
CIPS.
The cross-border interbank payment system. It was engineered specifically to serve as a parallel clearing architecture to the Western-dominated networks, offering an alternative routing mechanism for trade settlement that completely bypasses U.S. jurisdiction.
I mean, there is a profound geopolitical irony embedded right at the center of this shift.
Completely.
By utilizing the legacy financial system as a weapon of statecraft, the architects of those sanctions are directly and rapidly fueling the creation of the shield against that very weapon.
Exactly. By exiling major economies from SWIFT, they are forcing the accelerated development and stress testing of a parallel financial ecosystem.
And that parallel ecosystem is taking concrete shape under the broader macroeconomic umbrella of the BRICS Plus bloc, right?
It's the fragmented multipolar reality. With the recent expansion bringing in major economic players like Saudi Arabia, the UAE, Egypt, Iran, and Ethiopia, this bloc now represents roughly 28% of global GDP.
Almost a third of the global economy.
Right. And they are not merely relying on Chinese infrastructure. They are actively developing alternative, sovereign technological systems. We are analyzing the rollout of initiatives like BRICS Pay and the expansion of Russia's SPFS messaging system.
Engineered from the ground up to bypass the dollar-centric, SWIFT-reliant network.
Exactly. They are consciously building a fragmented, multipolar financial reality.
But I want to inject some realism here for a second, because it is incredibly easy to look at those developments, see the headlines about BRICS Pay, and just declare the imminent collapse of dollar dominance.
Yeah, that requires immediate and significant clarification.
Right.
What we are analyzing is absolutely not a global collapse of the dollar, nor is it an overnight dethroning of Western financial infrastructure.
Next.
When we widen the lens and examine the broader emerging market world, the vast majority of nations operating completely outside of these highly sanctioned zones, the shift away from the dollar is barely registering on a macro level.
Barely registering.
Across those non-sanctioned emerging markets in Latin America, parts of Africa, and Southeast Asia, the drop in the U.S. dollar share of correspondent relationships and the corresponding rise in the yuan's share is statistically negligible.
Like how negligible?
Well under 1%.
Less than 1%. So the sky isn't falling.
Right. The radical fragmentation we are detailing is currently hyper-concentrated in specific geopolitical flashpoints.
But even if it's hyper-concentrated, it still matters.
Vital, because it's vital to understand the function of these flashpoints. They are serving as a live, high-stakes operational proof of concept for a post-dollar infrastructure. Exactly. They are demonstrating to the rest of the world that a parallel system can technically function under pressure, even if its current liquidity and scope are limited.
So, if the era of a single, unified, globally trusted payment system is fracturing into this multipolar, highly volatile environment, how does the system actually survive?
Question.
Right. Like, if you are a multinational corporation, how do you ensure that a legitimate multi-million-dollar transaction doesn't get caught in the geopolitical crossfire and frozen in transit?
Well, this leads us to the architecture of resilience. We have to look at how institutions are adapting to a world where the pipes keep moving.
So how are they rebuilding these pipes? What's the push for institutional continuity look like?
Survival in this newly fragmented paradigm requires a complete overhaul of how institutions approach risk management. Central banks and major Tier 1 global institutions are aggressively developing and testing what are known as resilience and continuity models.
Okay, resilience and continuity models.
The era of relying solely on static compliance lists, checking a spreadsheet of banned entities once a month is entirely obsolete.
So what's replacing the spreadsheets?
The cutting edge of infrastructural resilience is now reliant on AI-driven risk monitoring.
AI-driven risk monitoring. I need to pause you there because that sounds a bit like corporate jargon. I understand AI reading global news feeds, but how does an algorithm actually know a correspondent bank is going to get cut off? What does it actually look for?
It is entirely mechanistic. Think of it less like a crystal ball and more like a meteorologist tracking a storm system.
What's getting the weather?
Exactly. The AI isn't predicting the future magically. It's tracking the atmospheric pressure of global data. These frameworks ingest massive, continuous streams of unstructured data.
Yeah.
They process global news feeds in dozens of languages. They analyze the specific legal phrasing of regulatory announcements. They track subtle shifts in diplomatic rhetoric. And crucially, they monitor microscopic anomalies in the velocity and routing of transaction flows.
Okay, so give me an example of how that pieces together.
Sure. Let's say the AI detects that 3 different mid-tier banks in a specific region have quietly shifted their dollar clearing to a new intermediary within a 48-hour window.
Like rats fleeing a sinking ship.
Right. And simultaneously, diplomatic language between that region and the U.S. has escalated in hostility. The algorithm flags a high probability of an impending infrastructure sanction.
It sees the regulatory winds shifting, and it tells the bank to reroute the planes before the hurricane even forms.
Precisely the right analogy. And rigorous backtesting of these models shows astonishing results.
Let's hear the numbers.
They can identify 78% of major payment disruptions a full 30 days before the regulatory intervention actually occurs.
Wait, 78%, a 30-day early warning system.
Yes, 30 days out.
That fundamentally changes the dynamic. That goes from a panic response to strategic maneuvering.
It allows for proactive rerouting. If the AI detects a high probability of a correspondent corridor being severed, the institution can seamlessly shift its clearing pathways.
Set up new correspondent lines, adjust currency exposures in advance.
Exactly. And the operational data indicates that implementing these predictive frameworks reduces actual disruption incidents, meaning frozen funds or delayed shipments, by 67%.
67% reductive.
It's the transition from reactive panic to algorithmic foresight.
But the technology goes far beyond just monitoring the old pipes to avoid blockages, right? The financial sector is actively laying entirely new kinds of pipe.
Absolutely. The integration of TradFi and decentralized tech.
Right. We are witnessing a fascinating convergence where traditional finance, or TradFi, is absorbing the architecture of decentralized technologies. Global banks, which have historically been the most deeply conservative institutions on the planet, are heavily experimenting with blockchain-based settlement systems.
Systems like WeTrade, for instance.
Exactly. They have been utilized to bypass centralized intermediaries altogether. They're utilizing asset tokenization, representing physical goods or fiat currency, as digital tokens on distributed ledgers to fundamentally alter how value moves.
And the true resilience of these decentralized systems relies heavily on a mechanism called cross-chain communication protocols, and specifically atomic swaps.
Atomic swaps down. To understand why this matters, let's look back at the traditional correspondent chain. If point C in an A to B to C to D chain fails or is suddenly sanctioned, the money is trapped in limbo at point B.
Right, the frozen terminal scenario.
So how does an atomic swap on a decentralized network solve this? What does it actually do in practice?
An atomic swap uses what are called hash-time locked contracts. But think of it like a highly secure digital vending machine.
A vending machine.
Yeah. When you put a coin into a physical vending machine, there is no intermediary banker holding your money while deciding if you deserve the soda.
Right. The machine just does it.
The machine's internal mechanics dictate that if the exact correct coin is inserted, the soda drops. If the machine jams mid-vend, the mechanism fails entirely, and your coin drops back out into the return slot.
You never just lose the coin in limbo.
Exactly. An atomic swap works on the exact same principle, but for millions of dollars across different blockchain networks. The transaction is programmed with cryptographic certainty to either execute completely, settling the trade simultaneously for both parties, or fail completely and instantly revert the funds to their original owners.
So there is zero possibility of the funds being trapped in a sanctioned intermediary's vault.
Zero. Furthermore, the decentralized nature of the ledger means that if one geographic node, say a server farm in a targeted country, is politically severed from the broader internet, the blockchain's architecture automatically and instantly reroutes the transaction validation through alternative operational nodes globally.
The network fundamentally routes around the geopolitical damage.
Wait.
But, I mean, this raises a massive red flag.
I know exactly where you're going with this.
Right. If we move the global economy onto decentralized ledgers and AI-routed atomic swaps, aren't we just stripping away the exact regulatory oversight that prevents money laundering and terrorist financing in the first place?
It sounds like a regulator's nightmare.
It sounds like the banking industry is using the excuse of resilience to build a highly efficient, automated shadow banking system that operates completely outside the jurisdictional control of sovereign states.
And that is the natural, immediate concern of every regulatory body in the world. But the reality of how institutions are adopting this technology involves what is termed an adaptive governance framework.
Adaptive governance. Yeah.
The objective for Tier 1 banks is absolutely not to evade regulation. The penalties are far too severe for that.
Right, nobody wants an $8.9 billion fine.
Exactly. The goal isn't evasion, it's to automate it seamlessly. Within these enterprise-grade permissioned blockchain systems, the smart contracts actually embed programmable compliance logic directly into the code of the token itself.
So the regulation isn't enforced by a human compliance officer staring at paperwork?
No, it's written into the DNA of the transaction itself.
Oh.
And because it is written into the code, it completely removes the human hesitation and the fear that paralyzed Demir in Istanbul.
Point.
These smart contracts feature dynamic sanction screening that updates in real time through secure data feeds, which are known as oracles.
So when a company tries to make a payment,
When a company attempts to initiate a transaction, the smart contract automatically cross-references the identities, the jurisdictions, and the specific goods involved against the absolute latest global regulatory requirements,
it satisfies jurisdiction-specific rules automatically.
executing the atomic swap only if all compliance parameters mathematically align. It combines the hyper-resilience and routing efficiency of a decentralized network with an absolute, immutable, cryptographically verifiable ledger of regulatory tracking.
So it's not a shadow system at all.
No, it is a highly controlled, radically transparent environment. A compliance officer in Frankfurt doesn't need to panic and freeze a shipment of industrial parts because the code has already verified the transaction against global sanctions lists before it ever reached their desk.
But, even if we build these perfect AI-governed decentralized pipelines, it doesn't matter if the lock on the vault can be shattered by the next generation of computers.
The quantum threat.
And that brings us to the final and perhaps most terrifying technological disruption vector we have to address in this deep dive. It represents a paradigm shift in cryptography itself. Quantum computing.
This is the existential threat to all of it.
It brings with it a strategy currently employed by malicious state actors known as harvest now, decrypt later.
Harvest now, decrypt later.
Yeah. They are actively intercepting and storing massive volumes of currently encrypted financial data, waiting for the day when quantum computers, utilizing mathematical models like Shor's algorithm, reach sufficient power to instantly break modern RSA encryption.
And when that day comes,
Decades of sensitive financial communications, trade secrets, and routing data will just be exposed.
the quantum threat is literally an existential deadline for the global financial system. The encryption that secures the SWIFT network and every major correspondent banking ledger will eventually be obsolete.
So how do we survive this?
Institutions are engaged in a desperate, incredibly expensive race to implement quantum recumbent cryptography. But securing the encryption algorithms is only half the battle. The data itself, the actual information transmitted in the message, must be structured in a way that can survive, be instantly verified, and route efficiently in this fractured, highly scrutinized world we've been talking about.
Right.
This absolute necessity for pristine data is the driving force behind the massive global migration to the ISO 2022 messaging standard.
Okay, ISO 2022, the coexistence period for ISO 2022, the window where banks can use both the old and the new messaging formats, ends in November 2025.
It's coming up fast.
Very fast. What makes this new standard so fundamentally different? Why is it the key to survival?
To understand ISO 2022, you have to look at the flaw in the legacy systems. The old messaging formats are basically like sending a postcard with the scribbled, unstructured note on the back.
Like, send money to John Smith in London for goods.
Exactly. It relies on fragmented, messy data fields. When an AI monitoring system or a compliance officer looks at that postcard, they have to guess the context. Which John Smith? What goods?
And that ambiguity is exactly what causes payments to get frozen out of caution.
ISO 2022 completely overhauls this. It is like replacing that scribbled postcard with a massive standardized digital spreadsheet.
With hundreds of locked, explicitly defined cells.
It creates a universal standard for richer, highly structured data payloads. Every single transaction carries explicit, standardized, instantly machine-readable information.
Information about what exactly?
About the ultimate origin, the exact purpose, the specific line item goods, and the ultimate beneficiary of the funds.
So there's zero ambiguity.
Zero. In a highly fragmented, multi-network environment where payments might be automatically rerouted by an AI across varying, highly sensitive jurisdictions, that rich, structured data is the only thing that allows smart contracts to verify compliance instantly.
It eliminates the ambiguity that triggers fear.
Right. Preventing the transaction from being blocked by a cautious intermediary.
Well, we've mapped out an absolute foundational paradigm shift today. The era where financial infrastructure was an invisible, neutral utility, something we simply trusted to operate in the background of global trade, is permanently over. The plumbing of the global economy is now a highly active, highly volatile variable. Analyzing a company's balance sheet, looking at their cash reserves and their debt ratios, without analyzing the geopolitical durability of their payment corridors. It's akin to analyzing the horsepower of a ship's engine without bothering to check if there is actually water in the ocean.
Money, at the highest levels of global trade, is no longer a mathematically objective store of value, nor is it a physical asset that you simply possess. It has evolved into a highly conditional permission slip one that exists entirely at the mercy of geopolitical infrastructure, capable of being permanently revoked at the speed of a digital keystroke.